Well, the first thing to remember is that even though Canada is geographically very large, it is in fact a fairly small open trading nation. In fact, we are among the most open trading nations in the world. We have free trade agreements in place with about 2/3 of the global economy, and are in negotiations with a good chunk of the rest of the world to have agreements in place with them as well. So that does mean, though, that global trade needs to move. As you'll be aware, President Trump reopened what was the North American Free Trade Agreement, and after protracted negotiations, the three countries, Canada, US, and Mexico, agreed to what's now going to be called the USMCA. And really, that actually hasn't changed very much. It was, to a large extent, an updating of the NAFTA agreement to take into account the last number of decades since it had been come into force, and was in many ways, from the Canadian perspective, things that we'd already agreed to under the Trans-Pacific Partnership, of which we are still a member. So that said, the United States remains our most important trading partner, and we are actually their most important trading partner too, at least the #1 export destination for about 31 states. So it's important to get this done. It still hasn't been ratified by Congress, and we aren't entirely clear on what issues are still outstanding and how we'd feel about them, but I think it's important to get it done. At the same time, we have had good trading relations with China, which have recently come under strain, as at the request of the US government, the Canadian government detained the CFO of Huawei, and she's facing extradition to the United States. The Chinese government is unhappy about that and has put on various sort of trade constraints and tariffs on Canadian goods. However, on the goods that aren't under these sorts of constraints, the trade continues to boom. So all in all, the Canadian economy is doing well. I think one of the more interesting things that's happening is what's happening with oil. In the last number of years, with the boom in US shale oil and the difficulty that the Canadian companies have had getting their shale to market, both to the West Coast to try and ship it internationally, and to expand the pipeline capacity coming down to the United States, the Canadian producers have been suffering. They already sell their oil at a discount to WTI, what's called Western Canadian Select. But with the constraints on export, just in terms of capacity, there's only so much you can do by oil by rail. They've been suffering quite a lot. I think you're actually starting to see some new life there. And then if the current uncertainty in the Arabian Gulf persists, then you could actually see more. And that might actually help the Canadian producers and the Canadian pipeline companies get some of their projects done and get their product to market. If you look at the performance of the Canadian market and the Canadian economy versus most of the other developed economies, you'll see that coming from before the financial crisis to now, it has actually been one of the best performing markets in the world, both in terms of GDP, job creation, and stability. Remember, we have one of the most stable banking sectors in the world, most stable housing. We haven't had a housing crash. We didn't have a banking crash. So things have persisted. Since the US got rolling again and oil came off, people have been neglecting the Canadian market. Not that so much that oil came off, but the Canadian oil came off. People have been neglecting the Canadian market. And I think this is one of the issues where they've slightly misunderstood it, because particularly US investors tend to focus on Canada as materials and resources. They've missed other things that have been happening. And so even though the Canadian market has trailed the US market in this time, there have been a lot of good sectors you can invest in, and particularly very high performing companies. And as local investors, we've been able to do that. And so now you're seeing a situation where Canada has a stable, and it looks like somewhat perking up, housing market. The financials look stable. The other sectors have been fairly robust, and you're also potentially seeing something of a recovery in the oil sector in a market that is, relative to its US peers, undervalued. Well, I think the first thing to remember is that there's a big world out there, and it's full of people working hard to make a lot of money for themselves and for their shareholders. And you see that reflected in the various companies. We're not in the world of the 1960s where the global market really was the U.S. market, and there wasn't much more. And if you look abroad, you can see that in certain spaces in different countries, you can really see some fantastic companies often trading at a discount to their U.S. peers. And so not only does that give you opportunity, it also gives you some stability. I mentioned earlier how in Canada we had a very stable financial sector and housing sector. So had you been invested in that, in the Canadian market over that time, just the index, forget about the active management segment of it. Had you been invested in the Canadian market over that time, from 2000 until now, you would have been, along with the Australian market, in the two of the top performing markets over that whole period. So, and as well, both of those markets didn't experience the same sort of crash and upheaval that 2008 saw. So it would have added stability as well as performance to your portfolio.
Jonathan, you're an active investment manager. What advantages do you see managing assets in a closed-end fund structure?
Well, first of all, in the closed-end fund structure, you have the ability to take a longer view of things. You can sometimes get into companies that are more early stage because you don't have to worry about funding redemptions than you would be able to in an open-end structure or in an ETF, where you typically wouldn't be taken account of until they hit the index. So, for example, being local investors, we've invested in certain companies on their IPO, which have then become world beaters. One example of that, we didn't invest in the IPO, but shortly after, was Shopify, which is our #1 holding, and we've held that since shortly after the IPO, and that has been a tremendous win for us. And that's in part because we're local to Toronto, we invest in the Canadian investment scene, and something that people outside of Toronto often don't realize is that it's one of the largest and fastest growing tech hubs in the world. And it continues to grow at great pace, and there are all sorts of junior companies coming up through that sort of incubator space that are quite interesting to look at. And although Shopify didn't come out of Toronto, it came out of Ottawa, I believe, which is another hub. So an example of a company that we bought on the IPO, because we're local to the investment scene and have both local knowledge and a long track record, was Franco-Nevada. Now, Franco-Nevada is a company that has had double-digit CAGR returns on its shares since the IPO. We've held it since then, and it's really a royalty company, largely for gold, but it also has some oil and other assets in it in terms of royalties. The reason we bought it is we used to own it. There was Euro-Nevada, Franco-Nevada, and Normandy, I think, were three companies that merged, became Newmont. At some point, Newmont decided that these assets were no longer core, so the same assets, the same management, which we'd had a big win on before, came out to the public market, so we bought in the IPO, and that's been a tremendous win for us as well. And I think that's one of those things that's really important. If you're looking to diversify outside of the United States, you have to remember, first of all, that you may not actually have a very accurate picture of what the markets are like. Americans tend to look at Canada as being dominated by resources and materials, and at times when those sectors are moving, those have dominated our stock market. But that's not really the economy, and there's lots of other things going on, and as an active manager, you can do that. On top of that, it's important to remember that once you're outside of the United States, and you could say London or Japan would be other examples, but in a lot of other markets, the stocks can get pretty illiquid pretty quickly, and you don't necessarily want to be in an ETF, say, where they're supposed to be doing mark-to-market every second, and not all these things can be priced all that accurately. Not to mention, if you want to get out right away, you're going to find out that you're not really owning the underlying, you're owning some sort of strange option strategy, which may or may not work if you're rushing for the exits. And the same thing with a mutual fund, an open-ended fund. They just can't invest in some of the things that a closed-end fund can invest in because they have to worry about their liquidity constraints.